we're going to have a look at the answer to Zolmar. Here's the answer, here's the question. Income statement here, 2015-2016, note that. Then statement of financial position 2015-2016. The cash flow statement follows a traditional pattern. First of all, cash flow from operating activities. We deal with these items first, then the working capital, and then financing type payments. Then we have investing activities and financing activities. That's the issue of any new finance. All these movements come to a net movement of -4, which explains the movement in cash and cash equivalents from 6 in 2015, where is it? Here, down to 2 in 2016. So all these movements come to -4, which explains this movement from 2015 down to 2016, or the 1st of January 2016 to the end of 2016. We start with, as we always do, with profit before taxation and after interest of 9, and effectively we're saying this is a positive cash flow. So we're implying that all our sales were in cash and all our expenses, all our charges on the income statement were also cash. Well, the big item there that isn't a cash flow is depreciation. Right? It's a provision. So it's a credit to a depreciation provision and a debit to the income statement. That is as per our note, so 36,000 there, we're told what it is, so we're not going to worry about that. But we need to add it back in because it wasn't a cash outflow. And we've effectively assumed it was in looking at this profit figure. Then we have the interest expense that we want to add back in because we want to deal with it later. And that is from the income statement. So it's this one here, this 22 there. That then comes to a net of 58, the 36 and the 22. And now we look at the working capital. Again, the previous video explaining cash flows gives you the rationale for this in terms of the accounting equation. But we'll look at it here in terms of kind of rational explanation. These figures come from the difference in the statements of financial position. So we have an increase in receivables from 80 to 96, that's that 80 to 96. And if we have an increase in debtors, it means that the revenue we assumed was all cash was not all cash. Some of it was not paid, and therefore we've got to reverse our cash flow assumption, if you like. It wasn't a cash to the tune of 16,000. Then we have an increase in trade payables, and we assumed with our expenses that it was all paid. Some of it wasn't, some of it just went to increase creditors. And so that's going to mean that we've got to add back some assumed cash outflows that weren't cash outflows. So we've got to add that back in. So an increase in trade payables is a source of funds. Then we have an increase in inventories, which we can think of as a purchase of an asset. And we're going to assume that's a cash outflow and therefore a -15 there. As I say, if you want to see it in terms of the logic, in terms of the accounting equation, then the previous video on explaining the cash flow statement has that explanation. If we add all these up, we come to a +75. We now deal with these financing costs and interest paid. Well, to see the interest paid, we do look on the statement of financial position to see if there's any indication of interest outstanding or anything like that. We don't see that, so we can run with our assumption that it was all paid in cash. Next one, we have taxation, and here we look down and we need to tick these off as we deal with them, because every item on the statement of financial position should have been looked at with respect to the cash flow analysis. Taxation, now that does appear, so we've got to work out carefully exactly what we paid. To do that, we've got two pictures here. This is the T account, and as an accountant you should always be able to translate things into T account form, particularly if you're being asked to assess, criticize or analyze the account in any way. You should be able to do this. So we've got here the opening balance of 4,000, which we take from our statement of financial position up there. We had a charge of 4,000, right, so that we owe because we've been charged it, and we know that the balance carried down at the end was only 2,000. Therefore, we must have paid 6,000. So it's this kind of implied element that we use, and we call that tax paid. So you should always be able to reproduce that if asked. In terms of the statement, you might want to explain it like this. So tax owed at the start of the year plus tax charged during the year means that at one time you would have a bill of 8,000 less the closing amount leaves what must have been paid of 6,000. So both approaches come to the same conclusion. We now have dividends paid. Now, dividends paid is given to us in a note, so we're not going to worry about that. And it doesn't appear in our balance sheet, so we've got no problems there. That then gives us our net cash flow from operating activities of 42. We then want to look at cash flow from investing activities, that is, what happened to our fixed assets essentially. And to work out that, we need to again look at the account. The advantage of using the double entry approach is that it is relatively, it copes very well with different explanations. So we'll start with this and then we'll move on to that one. So the opening net book value was 110, and that we get from our statement of financial position of 110, and the closing balance is 125. So the opening balance is 110 and the closing balance carried down is 125. We then, during the year, we will have charged depreciation, so it's a credit to this, lowering the net book value, and a debit to our income statement. This then totals 161,000 and this side is 110,000. We need to make it up to 161,000 to balance the account. Therefore, the additions must have been 51,000. Or we can present it as a statement in much the same way as in the tax argument statement. We have our opening net book value of 110,000. We have our depreciation charge of 36,000, and we have the positive lowering our net book value. Then we have our closing net book value of 125,000, and that closing book value carried down can only be explained by an addition of 51,000. So that's the kind of statement approach, and this is the double entry T account approach. We therefore have a net acquisition of 51,000, just like our increase in stocks, if you like, which is also an asset, a current asset as opposed to a non-current asset, but they're both drains on our funds. So minus 51 there is net cash used in investing activities. Then we have cash flow from financing activities. This is something that would be unticked on your statement of financial position. We have financing loan notes here, went from 55 up to 60. So we must have issued 5, and that is a positive effect on our cash flows. So a positive net cash flow from financing activities gives us that. There's nothing else to look at. Everything has been dealt with here, and or there's been no movement as in ordinary shares here. So we can total it all up. Plus 42 minus 51 plus 5 gives us negative 4. And that negative 4, as we said at the beginning, explains the movement from cash at the end of the previous year and beginning of the current year, which is 2016 in this case, was 6 cash and cash equivalents. There's no overdraft and there's no near cash items, so it's just cash. Was 6 at the start of the year, it was 2 at the end. That's been a net negative movement of 4, and that is that minus 4 there, explained by these movements up here. Okay, that concludes our look at Zolmar.